investments?
Sure. So great to see you all. So I'm Chris. I'm managing partner at Playfair, based in London. In terms of my background, it's a bit random and a bit meandering. So I was a corporate lawyer doing private equity for 10 years. Made me very unhappy. It was horrible, but the financial crisis in 2008 kept me there much longer than I expected. I also set up my own telecoms business when I was at university, so I had the experience of being a founder and then having a co-founder join me. We scaled that to 14 countries, made a ton of mistakes, which I certainly wouldn't make now, but it was a really good learning experience and had fun doing it. I also angel invested for about 10 years, starting in 2007, after a little bit of time in Silicon Valley. Made about 15 investments, but had 6 exits from those. A couple failed, so a couple looking pretty good. And then immediately prior to Playfair, I worked for a B2B telecoms company as an operator for 5 years. So 2 years as sales director, 3 years running the software development and data science team. We got to about 100 people, about 60 million of revenue by the time that I left and joined Playfair. And then on to Playfair. So I've been here about 5 years. We're a pre-seed fund, I think I mentioned. So we have been around since 2013. We're investing out of our 3rd fund, which is unannounced. It will be announced in the next couple of weeks, $70 million fund. And we're a bit weird. So we are pre-seed investors, but we do only 6 to 8 investments a year. So it's a sort of highly concentrated, intentionally low volume strategy. We write about 750K checks and then reserve a decent amount of capital to follow on. So our kind of North Star metric is to get our companies, our founders, from pre-seed to Series A. And currently our graduation rate's running about 73% versus the industry average is about 20%. So something's working, and that's why we raised the 3rd fund to double down on that strategy. What else to tell you? We're generalists, so we kind of look at everything. There's a really short list of stuff that we don't like to invest in, which is in the frequently asked questions on our website. It's kind of like guns and bombs and stuff, and actually lending, which is more an ethical thing. And then there's a couple of things which are more sort of business model related and historic. So, but pretty short list, but we're excited by most things. And then the team is 7 full-time investors, and that's us.
Awesome. So just a bit more detail. You're investing at pre-seed, but you're doing low volume of investments. Typically, what is your check size?
Yeah, 750. So that's an average. And we can flex down as small as like 100K if it's a friends and family or angel type round. And then we can go up to 1.5 million, which is reserved for those. We'll probably talk about it later. Like there's rounds that get hot for whatever reason, and they become much bigger than we expect. But on average, it's about 750. And we typically co-lead.
Okay. Yeah, I was going to ask that as well. So co-leading. Question, I guess, why do you think what you're doing is so successful compared to how successful other VCs are? Like, how are you picking the winners every time, or the much more of the time than other people are?
Yeah, so there's a big caveat, right? Because the feedback loop in venture is incredibly long. So maybe in 10 years, I could really confidently answer that question. But in terms of what we do look at and that graduation rate, it seems to be working. I think it's a combination of things. I think it is the sort of depth and discipline that we have in our process when we actually talk to and review founders and their companies. We may get onto that later, but we go pretty deep. We end up writing, pretty significant investment memos and spending a lot of time with the founders to build our thesis and try and figure things out. That means hopefully we make good decisions, but it also means we're well placed to help the founders once we invest. And then I think we basically try and help across a few key areas. And I think they're the ones that founders often need the most help with, not always, but particularly hiring and talent has been a big piece of sort of what we offer. So figuring out the people strategy and then actually helping the execution of that. Sales and go-to-market, which we typically invest in quite a lot of B2B companies, a bit deeper tech. And so the founders aren't necessarily familiar with sales. So we can take it right back to like, how do you set up a CRM and what's your qualification criteria and how do you think about it, through to sort of more strategic stuff. And then we also offer a lot of support on finance. So getting your model right for Series A in the next round and actually helping with that fundraising process. So, we've done a couple of processes recently. We put 150, 200 investors into the top of the funnel. So I think it's probably that combination of things that has helped.
Yeah. So one of the things that you talk about on LinkedIn is this investment memo that you just mentioned. So when you are writing them, This is when you're at the stage where you've made the investment, or is it just before you're making the investment that you would write this memo?
Yeah, I'm really transparent, I guess, about the process. So a pitch deck comes into us, however it comes in. It could come in through our website, could be a referral, could be outbound, could be any of those things. We review it, or we decide to take a call. And if we take a call, we have 2 calls before we have what is like a really sort of key gating point for us when we decide whether to progress to the investment memo or not. So basically at that point, we're saying, look, we really like the look of this company. It makes sense to put resources into it. And then we write the investment memo to help us really refine our thesis, and also to have something to take to the investment committee and then debate. So once you get to the investment memo stage, that's pretty promising. I think the conversion rate from sort of investment memo to actually writing a term sheet is probably about 50%, which doesn't sound that high, but compared to the rest of the conversion rates is pretty high.
Yeah. And what goes into the investment memo?
Yeah, so it's let's start at the top. You got to imagine this. So at the top, it's our investment thesis. So basically the key reasons we actually want to invest into the company. That's then followed by the antithesis, which maybe in other memos would be like the sort of key risks, and then an executive summary. So we can basically get the whole sort of gist of this company in 2 pages. Then we go into detail, and the rest of the memo is split into a bunch of sections. I'm actually scrolling through one now so I can tell you properly. So there's a problem section, there's a solution section, which is product and technology. There's market and competition. Keep scrolling. There's a business model and financials, go-to-market strategy, team, and we're nearly there, traction to date, defensibility and future moat. And then we ask ourselves a question: what needs to happen for this company to reach a large outcome? And then we have a few pieces around the actual financing structure of the round. So in some ways, that kind of mirrors how a deck might be set out. We're basically trying to break down each like key component of the company.
So is there a way that the founders can make, because you're the ones doing the memo, is there some way that the founder can make your life easier? I guess the answer is answer all of those questions up front in a deck that they do submit, so that you can see, and most of the things are on a deck anyway, problem, solution, go to market, that kind of thing. But any other tips on how a founder could just really nail it with the pitch?
Yeah, I mean, I think you're right. It should be on the deck. So on our website, there's a blog section, and actually Jivan wrote a really good post about how to do a deck in 12 slides. I'm sure you kind of have the same advice, and you guys are all up to speed with it. Just to say, actually, a lot of founders are not. So the assumption that all the decks that we see have problem, solution, not necessarily, right? So I think that's the first way of doing it. And then I think just having a level of rigor with your thinking, it really helps. So for example, let me pull out 2 areas. So like a competitive landscape, the more thorough that is, and the more information you can give us about the market you're operating in and competitive threats, and why you do or don't see them as threats, the better. Like the average kind of 2x2 isn't necessarily that helpful. So we want to know that you really understand the competitive landscape. Similar, I think, with market sizing, it needs to be robust. One example, a mistake that sometimes is made is a founder will choose like a global market size, and then we'll go, okay, is that actually global? And then suddenly you realize that half the market's in China. And then we're like, oh, are you planning to launch in China? No, okay, well, the market's half the size that you thought it was. So I think just imagine, put yourself in the shoes of the investor for a second, think about the questions they're going to ask, and then make sure you can kind of defend the pitch deck. But yeah, otherwise just follow that guide on the blog. This
is a bit of a subjective question, and it's just your preference, but do you like it when all of the decks come in the exact same order, or do you like it when people change up the narrative just to make your life a bit more interesting when you're reading through decks?
I don't mind. I think as long as it tells a story. I think I've seen a deck recently actually where they put some, like, this was a Series A deck, so it's quite different, but they put some like key metrics as their first slide rather than the problem slide, and I thought that's kind of interesting because now it helped me sort of frame the rest of that deck, or sets the context for it, which is that they're doing really well. I think it's just about the story, and very frequently, like if we think about some of the reasons we pass, or rather a founder doesn't progress to a call, it's because the deck fails to tell the story in a convincing way.
Yeah. And I think one of the challenges that a lot of the founders here have is not only that they can pitch the narrative, but the deck tells the story itself without you having to narrate it. Because if you're just telling a teaser deck over, you're reading it without the founder's passion and without the storytelling. And so the deck needs to do all of that work on behalf of the founders, which is actually really difficult.
Oh yeah, it's hard. It's really hard. I think sometimes using data is helpful, right? I think if you're trying to tell us that there's like this massive problem, is there a way you can quantify it? Whether it's through like you've asked 200 people, you've done a bunch of like customer surveys, or there's something you can pull out from an industry report. I think another area where we often don't progress to a call is where we just don't believe the problem is as significant as the founder potentially does. I.e. it's not significant enough to generate a venture scale company. So if you can use data to support that can be quite useful.
Yeah. One of the things that and the founders will know is that the point of this program is to make sure that you're building something that your users love. And so every week we're asking for this weekly growth update, and founders are encouraged to go speak to their users and report on whatever their North Star metric is and how that's grown. For you, what does good look like if someone has a traction slide? And I know that's different depending on business model and industry, but just kind of generally speaking, what do you want to see?
Yeah, so I'm gonna, maybe there's three potential scenarios here. I think that the first one is like pre-product, pre-revenue, which is not answering your question, but a lot of companies we see are in that sort of area. And so there, often what I'm looking for is that the founder has done as much work as possible to validate the fact that customers want to buy it. So if someone comes to us with a deck and says, I think this is gonna, I don't know, we had one recently, or actually quite a few years ago, but they wanted to put like a SaaS tool into the banking industry to replace Excel. And I mean, that's pretty bold, but I just remember that they'd spoken to 250 people who work within banks and used Excel day to day, and had like, 95% were interested in using it. So I think just receiving a deck and you actually haven't done anything to validate what the customer wants, that's a little more difficult. So that's pre-product, pre-revenue. I think in the early days, as you say, it's picking the right North Star metric. So, I mean, it could be anything from weekly, daily, monthly engagement. Again, I think the point there is, why are you tracking that? There are clearly going to be some B2B apps where daily would just be ridiculous. It doesn't make any sense. Monthly or weekly makes more sense. I think pick the right metrics that both make the company look good, like candidly, but also are relevant for the business. I do think one area we look at is we're trying to extrapolate trends. So churn is definitely a problem. And I think it's key, if you have had churn in the early days, sometimes it's a learning experience, right? And you figure out that was a very valuable customer churn because now you've fixed all these issues and you're not going to have it going forward. But I think this idea of, zero churn or more than 100% sort of net revenue retention because you're kind of upselling has become quite popular. So you need to make sure you put that across. So I would definitely look for that. I would look for not much churn. I'd look, if you've had POCs, I'd look for very high conversion rates from those POCs to a full contract. And then in terms of revenue, I think I always point to the SaaS napkin, which is Christoph Jans at 0.9. It's a great starting point, right? You've got to be growing 2 to 3x annually, basically. And there's a few other things in there as well. And maybe the final point is capital efficiency, which is things really come to bear now. So for every pound you're investing, you need to be generating a good amount of revenue. And again, I think in the SaaS napkin, there's some suggestions there on what good looks like, but capital efficiency is super important.
That's what I was just about to ask as my next question. Has it changed with the current economic climate? So are you more focused on sustainable growth and revenue earlier on rather than growth at all costs? I mean, both, ideally.
Yeah. I mean, we probably, again, we come in so early, we probably not, but maybe from the Series A fund perspective, yeah, absolutely. Like, they're looking now a lot more at the quality of your revenue, and that's through a few dimensions. One is it genuinely recurring revenue? Is it project based? Like, what is that revenue? Have you got visibility? Can you guarantee it's going to keep coming in? And then they're looking at, well, what did it cost for you to get there and what did it take? So that's the capital efficiency point. I think people are also looking at this is a sustainability and scalability of your acquisition channels. So, sometimes it can be, you can get from sort of naught, I don't know, 500,000, 1 million of ARR. Maybe you were doing it all through paid, or you were doing it all through influencers, or there was a particular channel you were using. Investors at A are looking for a really clear plan of how you get to the next stage at B, with sort of 10 million revenue, not with a dependence on a single channel that either may stop working or may become prohibitively expensive.
Mm-hmm. That makes sense. Something else that you talk about online is the pre-mortem that you do at Playfair. Can you talk us through what that looks like?
Yeah, so we tend to do it at or after the first board meeting once we've invested. It's a brainstorming exercise. So we sit with the founders and we think about every possible risk that could derail or could kill the company. And it's everything from competition to financing market or funding market changes to banking crisis, which we didn't really expect but happened. It's basically anything that can derail the company. The idea is you kind of get to the end, you flick up a spreadsheet, you end up with probably 30 to 40 risks, like everything possible. And then you really identify your top 10. And then the idea is you assign owners on the founding team, and their responsibility is then to monitor it and to try and mitigate it and to raise any issues that come up at the board. And those will change over time, so you kind of need to sort of recalibrate them. But it's worked very effectively, and it also helps avoid any blind spots. So typically, maybe one example, we did one of these recently, and actually competition didn't come up from the founders, it came up from us. And I think the founders' view was that, they read all this advice that you kind of ignore the competition, you're running your own race, focus on your own product. I think that's true, but like a lot of advice online, it lacks nuance. And of course, you actually do have to monitor what's happening with your competition to make sure they're not undercutting you on price or doing whatever they're doing in terms of their product development and their technology. So it just throws up those interesting blind spots.
Yeah, I guess that's quite good practice to get into before you're at first, like as the founding team, before you've raised as well, because then you can think about what potential risks are and how to mitigate them. And then if you've got investors that ask you about those in pitch meetings, you've already thought through your response.
Totally. Actually, and I think sometimes we ask the question to founders, like, what is your antithesis? Which is the same, like, what are the risks? Like, what are the key issues? And I think a polished response there gives us a load of confidence, because, as a founder, you almost have to suspend reality to a certain extent to believe you're going to build a huge company. And that's awesome. You should be doing that. But at the same time, you don't want to go too far and become unrealistic. And so that ability to understand what the risks are and how you mitigate them is super impressive as part of a pitch process.
Yeah. And one of the risks, I don't know if this comes up in every single pre-mortem that you do, but I imagine it is, if you've got a founding team, is the founder fallout issue. And we've spoken to quite a lot of investors about co-founders splitting up, and how actually investors have told us that if the founding team have already had an issue before they get investment, the investors are actually quite happy that that's happened, because they just think it's probably going to happen anyway. So they'd rather it happen before they invested than afterwards, and then it ends up killing the business. Do you have any tips for how to, I guess, nurture the founder relationship to avoid that founder fallout happening?
Yeah, for sure. And I think it comes across, by the way, in pitches, like we can tell if there's something a little bit off, and it's usually maybe like sort of slightly treading on toes when it comes to answering questions, or one founder is really dominant and does all the speaking, one doesn't speak at all, or like we generally can sort of pick up on those vibes. So I think in terms of advice, I think you want to start by being totally aligned on your goals. So, are you both, you three, you four, are you trying to build a huge company, for example? It's so fundamental, but actually taking venture capital and building a company in this way generally means you want to build a massive company. If you have a founder who's thinking, well, I quite want to just build a small or medium company, that's already a problem. So I think making sure you're aligned on the ultimate goal is a great starting point. I think there's then the practical side, which is we actually do this at Playfair, and again, our founders do this, but you need to write down your roles and responsibilities. kind of like a job spec for each of the co-founders, and that needs to be detailed. And the aim of that really is to avoid treading on toes. It's to avoid assumptions about what people are doing, and it's also to ensure a fair workload between the co-founders. And the idea there really is to recalibrate it every 6 months, because founders' jobs change all the time. So I think that's a very practical way of just making sure everyone feels that they're pulling their weight. And then other than that, it's like, I guess it's like other relationships. It's investing time. It's investing time outside the work environment. It's having meals together, going drinking together, hiking together, whatever it is that you enjoy doing, really investing that time. And that helps because it means that if you do have an issue, you're more likely to talk to each other about it. And the worst thing is that people don't raise an issue in the moment it happens. They bottle it up, and then it blows up into some massive argument that you can't come back from. So keeping those lines of communication open, spending plenty of time with each other are all things we really encourage our founders to do.
Yeah, that makes sense. I read something the other day about the rise of the co-CEO position. So
Yeah.
two founders who are both CEOs. Given what you've just said about defined roles and responsibilities, how do you feel about that?
I mean, I think it can work, because actually, as long as underneath you have that really clear roles and responsibilities. So it also depends why it's arisen. I mean, sometimes it arises because actually these two people are very equal in terms of their contribution to the company. They actually have pretty similar skill sets, or they could do. And so it's an icky choice to choose one of them. In which case, I think I said, as long as you have underneath that a really clear understanding of what each of them is doing in that role, I think it can work. I mean, is it optimal? Probably not, but I think it can work.
I'm going to ask a question from the chat, just because we're talking about founders. Do you back solo founders?
Yeah, absolutely. I think some funds would get a bit nervous because you've got a single point of failure, which is sort of a practical thing. And also, I think there was an argument that person has not been able to convince somebody else to join them on the journey, which may mean there's something peculiar about the business or even about that individual. But actually, some of our most successful investments have been solo founders. So I'm super supportive if that's what people want to do.
Interesting. And you mentioned at the beginning that you were a founder yourself. Do you think that has changed how you approach the whole investment situation? Like, are you more empathetic to founders? Do you think there's a big difference between like the whole debate at the moment about operators turn VCs versus like ex-bankers turn VCs?
Yeah, no, I think it's definitely a useful experience to draw on. So I probably had like one period as a founder / operator with my own telecoms business that in a VC sense was a total failure, because I set it up as a reseller business, didn't own the underlying asset, single point of failure. I could go on, but essentially it was never a business that could scale. That in itself was really good, lessons for then looking at companies now. And then I had one period at plan.com later on, which was a relative success. We got to 60 million of revenue. So I've kind of seen what doesn't work and what does work in the context of being an operator. So that's really helpful, I think, when assessing businesses and the likelihood they're going to be successful. But to your point about empathy, I actually think that's the most important thing. Like if you have someone who's going to be on the journey 5-10 years with you, and they've grown up in kind of an ivory tower, like working in finance or consulting or whatever. And I know that because I worked in law, and law was an ivory tower, and you realize once I got out. They perhaps just don't see the world quite the same way. And when you do have those difficult times, I'm not sure they necessarily react in the same way, or potentially are as supportive. And that's the issue if you kind of view everything through a spreadsheet. So I think ideally, if I was a founder again, I would want a balance. I think I would want people who have really good finance expertise who can help me figure out, how to get to Series A and beyond. But I would probably also want someone with a bit of, on the ground experience as a founder operator as well.
Yeah, that makes sense. I'm going to pass over to MA, who's going to ask a few questions, and then founders will be moving over to Q&A with you shortly. So have a think of any questions, raise your hand. Francisco, I know your hand's been raised for ages. We will get to you. And anyone else, feel free to do the same.
Chris, my first question for you is something that's been coming up in a lot of the pitches that we've seen from our founders over the past week are founders who spend the past year or so testing out assumptions for their startup, talking to all the users, and laying a really strong foundation. And they funded it either by like consulting, having a service-based business, or perhaps via like partnership or sponsorships. And now that they're going to fundraise for the product that they've spent a long time testing for, they're wondering how to position the revenue that they've generated kind of with the next phase of their business, and what role that should play in their valuation, their pitch deck, etc.
Yeah, that's a great question, actually, because I think traditionally when you're sort of moving, particularly if there's been a consulting element to a product, I think, and this may be a bit harsh, I think you entirely discount any revenue that came from the consulting business. It's not particularly relevant. I think the best way then to structure that narrative is that you've actually spent whatever period of time it is building and doing research and figuring things out. And that's great. And actually in some sectors, that can be a really long period. So like in healthcare and health tech, for example, you could spend 18 months or even 2 years doing everything you need to do to build the product, to get your CE mark, to get your approvals before you can actually start selling. So I'd really downplay any revenue that's been generated. I would talk about everything that's been learned from that period to create the product you have today. And hopefully what you have coming out the back of it is a really strong pipeline that you're going to be able to sell your product to. Impact on valuation. Valuation is just a function of dilution. And I think when the market was really crazy and booming, you could probably do around and get away with like 20%, maybe even 15% dilution. Unfortunately, those days have gone. I say unfortunately, I'm not sure it's totally unfortunate, but now it's more like 20 to 25, maybe a little bit more. So that is a function of competitive tension you manage to generate in the round as well. So my advice to all the founders I work with is, build the best story you can, build the best deck you can, speak to as many investors as you can, and then hopefully someone will fall in love with what you're doing. And then once they do that, you'll get a lead term sheet, and then you can start to hopefully create some competition around the round. Oh, you're muted.
Oh my God, I feel like a 60-year-old person whenever I do that. He's like, no, no offense if anyone's 60. That was bad phrasing. I shouldn't say that. Anyway, I read a blog post recently that was talking about what made Paul Graham so unique. And it's from the perspective of people who had gone through YC. And something that came up a lot was, I guess, like he has a really good ability at figuring out how to view things from like the customer point of lens. Because like as a founder, you're so in the trenches every single day, and it's difficult to see like, okay, you put this on a deck, but it actually makes no sense to anyone but you. Do you have any advice for how founders can try to put on their like objective outside of the business hat when going over a deck to figure out whether or not it translates well to investors or even customers? Yeah,
I think ask people who are outside your immediate network. So I wouldn't even ask other founders. I'd ask like friends, family, people who don't understand your business at all, to understand, because they'll tell you, do they understand what you're doing? And if they don't, that's actually a bit of an issue, because most of the investors you're pitching to do not understand your market inside out unless they're specialists. So you really need to distill it down into the most simple terms to get it across to basically a child could understand it. And actually, like, I don't know, I think my parents just about understand what I do, but like if I ask them to understand what this business does and they say yes, I'm like, brilliant, that's great. Like this is really clear.
Makes sense. Okay, my last question before we go to Francisco. Do you see the pre-seed and seed stage funding process change over the next 10 years? I mean, we've seen big shifts from like seed rounds getting massive to now going back down, and we have SEIS, EIS, so people can do more stuff with less money. What changes do you anticipate?
Yeah, it's a really interesting question. I mean, I think the emergence of a really vibrant angel ecosystem in the UK, I think that's only going to continue. And that's largely because the sort of barriers to entry have come down, with the people like Odin and Valban, and the basic people who allow you to write smaller angel checks. When I was investing as an angel, it had to be 25K, which meant it was very, I could only do very few investments. It meant lots of people couldn't invest. So I imagine we'll see more and more angels in the ecosystem, potentially more angel only rounds as those first rounds. There's kind of pros and cons of doing that. And I think we're also going to see more founders exiting and then potentially setting up funds or becoming more active participants in the ecosystem. I think we're kind of seeing it. There's a few of those happening now. We're a little bit lagging the US, where a lot of founders have already had a couple of successful exits and they're setting up funds. So to your point about like operators in venture, I think we're going to see more of that. And that will nicely balance out with the kind of more finance and sort of consulting backgrounds. Whether it can get more efficient because of technology, I am not sure, because I know for founders, the idea you have to pitch to like 60, 80, 100 VCs to find that magical fit is extremely tiring, really exhausting, and frankly quite boring to have to do the same thing over and over again. I don't know if there is a better way to do that with technology, because ultimately this is all about building relationships. And it's not just relationships with a fund, it's with an individual investor and a founder who vibe together. So if anyone can solve that, I don't know, but it feels like there will always be this element of having to have a lot of conversations.
Makes sense. All right, Francisco, you are up first. Then we're going to take a question around the chat.
Hi, Chris. Got a quick question. In 2020, 21, you were part of our investment sort of fundraising pre-seed round. We never really made it to a memorandum or investment memorandum. It was very early days for us. But you were part of my investment choices because of the reasons you outlined, because you guys just come across too good to be true. And I wanted to be part of that ride. And my question to you is that should you encourage us to reapply again, or encourage me to reapply again, or not?
Yeah, so that great question. So the answer is yes, and then there's like probably two caveats to it. So one, we encourage founders, if they get a pass from us at any stage, to take 6 months before they resubmit. And that's just largely because it probably takes 6 months to figure out a bunch of things that perhaps weren't quite right the first time. Yeah. And then the second thing is we invest only at pre-seed. And what that means is we will invest provided no more than about £1 million has been raised prior to us investing. So if you've done like a friends and family and angel, or like a really, really small round prior, it's still relevant for us. And yeah, absolutely kind of resubmit.
Awesome. You should expect my deck coming soon.
Cool.
Thank you.
Thank you.
All right, now I'm going to take a question from David in the chat. If you're invested in pre-seed, what does traction typically look like? What are the ranges of signs that it could work? What does that look like for you? You've kind of touched on that a little bit, but is there anything else you want to add?
I've touched on it. I mean, honestly, most of the things we invest in have no traction. So maybe it's worth just touching on, if there's no traction, what do we look at? And I think the answer is probably 3 key areas. One is the founder, and there's this concept of founder market fit, which I think is a good way of describing probably like 100 or more individual characteristics of founders we've learned to like and recognize as potentially predicting success. It's very qualitative and it's entirely imperfect, but just to give you 2 examples of actually maybe 1 example of founder is fine. So we invested in a business called Nori. It is an operating system for hospitality. So it helps restaurants figure out how to optimize their labor and their inventory to increase profit margins, like super timely given, inflation, cost of living and labor shortages. The founder built a fried chicken business in Dublin, expanded to 6 locations, and was running a 25% EBITDA margin, which is unheard of in restaurants. So that is a very extreme example of founder market fit, but we just look for founders who, so whatever they've done, show exceptional performance, but also like they have the domain expertise to build something really special. So that's probably like, I don't know, 80, 90%. We then look at the market. The market's got to be big enough to generate, venture-backed returns. And then we do look at, if there is a product, we then look at it and we look at the quality of the execution. So the reason I bang on about like beautiful decks and no typos and all this kind of stuff is because we extrapolate that to be a sign of how well you execute. So like if you're building a consumer facing app, we're going to go on the app store and we're going to look at reviews, or if the app is buggy, we're going to see it. So just making sure the execution is really strong.
All right, makes sense. Okay, let's take a question. Actually, Raphael, we'll go to you and then we'll go back to the chat.
Awesome. Chris, I really liked your point around churn, and I just wanted to dive into that a little bit more because I'm not sure if it's now better to have like zero churn or like some little bit of churn being indicated, given you mentioned that it's always good to have like one or a couple of churns to be able to actually see what has gone wrong and just address that. We have no churn up until now, and now stepping into our third quarter after our go-to-market strategy. So just wanted to see like how that's perceived by VCs and so forth.
Yeah, so I think it's in an ideal world, you probably don't have any churn. And that's because we're gonna imply a few things from that. We're gonna imply that your customers love your product. We're gonna imply that your account management and the way you're looking after the customers is also really strong. So if they've had any issues, you've been able to resolve them. So I think that probably is the optimal. Having said that, if you do have any churn, I think the best thing to do is actually to sort of call it out. And that you've basically what you've learned from that experience. So we definitely have companies in our portfolio where they've churned a customer. In fact, there was one company, they actually churned 3 customers, and they were devastated because they'd never churned anyone. And what they did a complete review of how they handled account management, and it led them to actually, oh wow, we're amazing at selling it up front. We are terrible at ongoing account management. So they realized they actually hired people. They created a dedicated account management function. And as a result, they haven't had any churn since. So I think as long as you can like generate good insights from the churn, then it's fine.
Got it. So it is something to be proud of and like just have that almost as a stamp in your pitch deck, like 0% churn or whatever.
Yeah, 100%. Yeah, I think anytime you can say your customers are so happy they're not leaving, that's a good thing.
Nice. Okay, that's awesome. Thank you.
Cool.
Again, this is something I'm going to take a question from Tim. You kind of just touched on this. The question was, what characteristics do you look for in a founder? But also in a deck, how do you, if founders, like you talked about the one who had built the fried chicken company and had great margins. How can a founder talk about past accomplishments in the deck? Yeah,
I think it kind of depends what in your background is kind of most relevant and what is, I guess, has the most impact. So let's start with, let's imagine you've worked at like a sort of a blue chip company. I don't know, you've worked at Goldman in banking, or you've worked at like Google, you've worked at these big companies. Stick it on the deck. You can't go wrong. Like people will be like, okay, that implies a certain level of training, a certain level of rigor and everything else. I think if you haven't done that, or you that's not the primary thing, then think about the things you have done which are exceptional. It doesn't necessarily have to be directly related to what you're building. So we've met founders who have been professional sports people. We actually invested in a founder. So George Richardson at Aerocloud's an ex-professional racing driver. So he raced for the Ferrari team, he podiumed at Le Mans, and we were like, right, and there's nothing to do with airports, which is the company he's actually building successfully now. But wow, like if you can live under that level of pressure and succeed doing something that intense, that's a really good starting point for being an entrepreneur. So I think pull out something exceptional and then try and have it in the deck is a really good way of looking at it. And just, it doesn't have to be really conventional. It could be something else.
All right, Amir.
Hi, Chris. Just a quick question. To my understanding, this fundraising is not just about the money, it's about the kind of marriage and how we identify the culture behind the investors and what their appetite, and whether we will be a good fit with each other or not.
Yeah, I mean, that's definitely right. Diligence the hell out of us. Like, don't be nervous about, I think some founders are nervous about sort of asking questions or asking for references or really pushing us on what value we can add. And you read a post recently where I said some founders are getting much better at this, right? They're much better at the DD piece, but I often get asked, like, what can you do for my company? And then we give the answer, and then that's it. And I'm like, well, you should ask for some examples. I think we spend all day talking about our funds, but like, yeah, put us to proof. Ask for examples. Obviously, take references from anyone in the portfolio, not just the ones that the VC offers up. The VC probably offers them up not just because they're probably good, but also because they work with that founder the most. So there's not necessarily anything dodgy about it, but definitely ask for other founders as well. Use your network, use whatever back channels you have. And then I think Landscape VC is great. Like, you go on there and you just get really like candid, quite robust reviews from people about their experiences working with investors. So yeah, definitely do your DD. And it's a gut feel. I would definitely, it's not always possible because of sort of remote work and everything, but try and spend some social time with an investor before you sign the term sheet. I mean, whether it's over coffee, dinner, lunch break, whatever, just try and spend a bit of social time with them. Do you actually like them and do you get on with them? Sometimes you won't have that choice and that's fine. Sometimes you've got to take the money, but ideally you actually want to enjoy spending time with these people because they're going to be involved in your company for years.
All right. Now I'm going to take a question from Jay. At pre-seed stage, after 250K SEIS raise, what is a good threshold for voting shares for EIS angel investors towards a $500,000 raise? 5K, 10K, 20K, or 50? And how many voting investors are okay on a cap table at the pre-seed stage? Jay, is there anything that is there any context you want to add to that question? I don't know if you're still
that's all, like, because we don't want to keep the threshold very high because there are a lot of potential interest from 5K, 10K in extended circle. So I don't want to say no. At the same time, I'm just concerned about having too many small investors on cap table. So just now wondering where to set the threshold, because sometimes people keep this minimum ticket size of 20, 25K, but I don't want to do it.
Sure, I get the question. I don't think, and I think it's kind of about voting, but it's actually as much about kind of like administration and management in the future. So I think in the old days, it was definitely 25K. I think that's probably a mistake now because there are lots of people getting started in their angel journey who are going to add a lot of value to your company, who probably going to invest as little as 2 or 5 or whatever it is. I think the main thing is to speak to the lawyers who are working on the ground for you and figure out how you wrap all of those smaller investors into some kind of SPV or some kind of entity that is basically one vote. So I mentioned Odin before. I don't know if Valban do the same, but I would try and wrap all these people into a syndicate, and then you only have to deal with that syndicate when it comes to signing documents for future rounds and that kind of thing. So I'd say minimum, fine, let angels in if they add value. Just make sure your lawyer deals with the administrative side.
Okay, but as a seed investor, if you see 30 investor of 10K, 20K, or some 5K, would you be okay with that, with voting rights?
Fine. Well, as long as it's wrapped up into the syndicate, and it's easy to manage, then what it actually tells me is that you've convinced a lot of people to part with their own money into your company, which can only be a good thing. So I think in general, it's a positive.
Yeah,
all right. Tim, we're going to go to you.
Thanks, Em. I actually put this question in the chat, but I thought I'd come on and ask it live. So, Chris, it's a question about the fund structure, your current fund.
Yeah.
And do you have a particular target time frame within which you would like to see an investment get to the point where it can deliver you that 100x?
Yeah, simple answer, no. So we're structured actually, we're a sole LP fund, which has some pretty sort of major advantages, not least the fact we don't have to spend 40-50% of our time fundraising. We can actually spend it working with founders, but no, we don't. I think we think about ultimately generating a really big outcome, and if it takes 5, 10, 15 years, even longer, that's absolutely fine. And I think we like investing, I wouldn't necessarily call it deep tech, but we like investing in technically quite complicated companies, which might take 2 or 3 years to even really have built and refined the product before they start sales. So we need that. We're happy to have that sort of long time period. One thing, it brings up a good point though. I think when you are talking to investors about potential investment, really good to understand where they are in their fund cycle. So if you're talking to a sort of a fund that is right at the end of a particular fund and doing their last couple of checks, they're going to want to return that in like 6 years, 7 years, because they'll generally have a 10-year fund life, and then maybe they can extend for up to 2 years. But it is definitely worth asking that question.
Okay, that's great. Thanks, Chris.
Sure.
All right, question from Jackie. At pre-seed stage, is Playfair open to investing via safes or just for equity?
Yeah, we're definitely open to doing safes. We've done a few, typically in non-UK companies. So the real disadvantage for safes here is that most of the rounds we do are super collaborative. So there'll be potentially other funds, maybe smaller funds in there, and there'll also be angels. And most of those want SCIS or EIS. So safe, you can't do it. So safe works pretty well if you're outside the UK and doing sort of an earlier stage round.
Okay. Ludmila, let's go to you.
Hi, thank you. Can you talk a little bit about the female founder of Sellers that you have the program?
I'd love to. Yeah. Thank you for asking.
Thank you.
So the next event is coming up. It's on the 20th of April. I think applications close on the 2nd. And maybe a tiny bit of history. So 2019, we invested in a company called Vine Health, 2 brilliant women founders. And they sent a press release to me and said, it said in there, 1p in every pound goes to women founders. And I remember reading it and I thought, no, it can't be right. And did my research and found out shockingly that it was right. And I spoke with the team and said, look, this is crazy. We got to do something about it. So office hours started in our building, and it was like 15 investors, 30 founders, incredibly noisy in this building, starting conversations. And then the pandemic basically meant we had to go remote. We thought it was going to be a really terrible thing. Ended up being brilliant, because then we expanded it UK-wide, not just London-centric, plus across Europe. So we're on the 9th edition, which is the one coming up. There are 160, 170 investors. There'll be about 300 to 400 founders. And each founder gets 4 15-minute sessions with an investor to either pitch or to ask a bunch of questions. So we're really important to note that. You don't have to pitch. You could come on and ask a bunch of really important questions that you're kind of trying to work through at the moment. And then hopefully you make 4 new connections. And the whole idea was that we think there are many challenges with all underrepresented founders getting the recognition and the investment they deserve. But here we identified access as just being a major problem. So this idea of needing warm intros, we just wanted to get rid of that. You know, anyone can apply and anyone can take part.
When's your next one?
Thank you.
Yeah, 20th of April, and then applications are open until, I think I'm getting it right. Let me just double check. I think it's Sunday, the 2nd of April. Yeah, so basically applications are open for another 10 days.
Okay, nice. Do you have any tips for anyone who's applying?
So it's not like a competitive application process. We want it to be open to all. I think the tips I would give are more about what you do when you get onto the session with the investor, which is to just recognize how quickly 15 minutes goes. The biggest mistake founders will make is they will pitch. It'll take 10 to 12 minutes. And then the investor goes, oh, we're running out of time. So really like snappy pitches and then key questions that you want to ask. The other thing to note is that we use some AI matching technology from a company called Grip. So most founders should roughly be meeting with investors that invest in their space. But a lot of investors are very generous with their time. So we might have like Series B investors taking part in this event and talking to a pre-seed company, in which case calibrate your questions. So you're not, at that point, you're not trying to get money, you're trying to get recommendations, you're trying to get information, you're maybe trying to get referrals to other investors. So just make a plan for each of those sessions you're going to have and research the investor ahead of time.
Okay, that makes sense. Next question from Jay. For pre-seed marketplace models without enough marketing funds, what are the ways to achieve the critical user density to demonstrate traction?
Oh, if only I knew. I think so the thing with marketplaces is actually, particularly in this market, it's got a little bit more difficult because the growth at all costs is gone. So you can't just sort of put money into customer acquisition. You have to figure out low cost and hacky ways of doing it. I'm not by any means an expert at growing marketplaces. But what I would think about is I would write down every potential acquisition channel on both the supply and demand side, and I would just test them super aggressively using the runway that you've got and the time you've got to figure out what is most likely to work. And then when you go to raise money, it's going to be about, I've got this really clear hypothesis about how I can grow this marketplace in a capital efficient way, and I want to raise money to test it. That's pretty much the position you want to be in.
Got it. Makes sense. Question from Gabriel. Do you prefer safes or ASAs for EIS?
So safes are not compatible with EIS or STS. ASAs are. The problem with ASAs is that they have, and I don't know if they've changed it, they were talking about it, but a 6-month long stop. So basically, if you don't do your price round within 6 months of that ASA being signed, the people who sign the ASA lose their SCIS and EIS, which is not a happy place to be. So ASA is best, but there is a certain risk attached to an ASA if you can't get the price round away in time. And so there's also a risk for the founder because the conversion will probably be at a pretty unfavorable valuation. So it's kind of like a double whammy. If you don't do it in time, you're going to piss off your investors who lose their tax relief, and you're going to get converted at a horrible valuation.
What advice do you have when, or like as an investor, what do you do when one of your portfolio companies is really struggling ahead of a raise? Like they closed their pre-seed, but gearing it for their seed round, they've been struggling. They're not sure how they're going to do in this market.
Yeah, I mean, that is a huge question. I think it kind of depends on why they're struggling. Sometimes it can be a function of time. So, I mean, we've actually done pro rata in 100% of our companies from the second fund. And I think not all of them have been absolutely killing it, right? Like some of them have been, some of them have not been quite as well. So I think if it's a function of time and it's pretty clear that they're making progress, then we can look at leading an internal seed round, doing some kind of bridge. That is all on the table. I think the biggest problem is when it's like a bridge to nowhere. So you don't really have a clear idea of what that money is going to enable you to do. So for founders in that situation, I think the key thing is like long, hard look at how you've got to this point. Like what assumptions have proven to be incorrect or what has gone wrong? And then if you can raise a small amount of money, say from your existing investors or angels or whatever it is, if you can scrabble together some money, what are you going to prove? And what milestones are you going to hit? Because it's about making people feel they're investing into something that obviously is going to work. It's also about building confidence in those investors. So if you set those milestones, you hit them, confidence is kind of restored. We haven't had in the past 4 or 5 years a situation where a company has shut down. I think that's a bit weird. I think it's probably a function of the market as much as us, I don't know, investing well. Yes, I think it's the market. I think there, to be honest, it's the empathy point. I think it's what the founder wants to do. And we've definitely had conversation with founders. It's actually come up in the context of M&A approaches. So we've had founders who've been approached, there's an acquisition on the table, I don't know, it's 20 million, whatever it is. It's pretty life-changing for the founder. It doesn't make sense for us. And what we do there is exactly what we would do when a company is struggling, which is it's over to you as the founder. What do you want to do? And do you want to take this? Do you want to get some financial security, or do you want to continue building and taking this opportunity? Same if the company's not doing very well. Do you want to scrap and you want to try and raise some more money, or is it time to figure out this isn't working for you?
Magic question. Okay, next question from Jay, and then Amira will go over to you. I'll try to make this fast since we only have 3 minutes left. Okay, what are your thoughts on investing in ed tech, selling directly to institutions? A lot of investors tend to stay away from it because of the slow sales cycles and limited budgets. How can we make it exciting to investors?
Oh yeah, that is the problem with ed tech, is who's going to pay, and are they going to pay you enough? I mean, I suppose there's a couple of ways of looking at it. You know, you could potentially target more of the sort of the private sector, or you could think about it geographically. So, you know, typically, I don't know, potentially in the US, colleges have bigger endowments and more money to spend on things than they do in the UK. So it is tricky. I mean, there are some great ed tech funds. So like Bright Eye is one of them. There's Emerge Education. there's a few of them that really specialize in this space. So I would definitely approach them, chat to them and see what they think. But that is basically the question you've got to answer. Who's going to pay for this? Are they going to pay enough? And are there enough of them to make it a venture scale company?
Sense. Okay, and Mia, last question.
Just a quick question. We are working on autonomous vehicle domain, which is a bit niche. Are you interested to work to invest in this niche market, or do you prefer a wider market?
I mean, it depends how big the niche is. So I think we're very happy to invest in sectors or verticals, particularly actually those that are kind of overlooked or kind of like unsexy sectors no one cares about. So I used airports as an example earlier. I mean, that's definitely one. We have like infrastructure tech businesses that no one's really looking at. So niche and kind of, as long as it's big enough to generate a venture return, I think is the answer there.
Thank you.
All right, we have to end it there. Thank you so much for joining us this afternoon. This was super, super informative. And yeah, you put out so much value on your LinkedIn posts. And so look forward to seeing more of those in the future too.
Great. Thank you so much for inviting me. And thanks everyone for taking an hour of your time to dial in.
Thanks, Chris.
Thank you, Chris.
Thank you.
Everyone will stop recording now, but as always, Purdy and I will stick around for a few minutes if you have any questions.